In this episode of Around the Coin, I interview Roger Khoury, the founder and CEO of Market Forecasting Academy. In this conversation, we talk about trading, the history of trading, where it's going, what it is, the difference in demand and price, arbitrage opportunities in trading, patterns of trading, the influence of AI, both today and in the future. Roger's really great. He gives examples and stories that help me understand what the value of trading is in our economy and how to better understand and utilize it. So here is Roger Khoury. All right, Roger, excited to be chatting with you. You have a really unique background compared to most people that I talk to. It seems like you really cultivated an expertise through your own life experiences in understanding and thinking deeply about resource allocation, capital allocation, like how to not necessarily make money in the world, because that's delivering value to other people, and people do that a million different ways. But everyone shares a similar problem when they've accumulated some wealth, is what to do with it. And there seems to be, from my perspective, I'll say this, it seems like if we have consensus on how to manage money, that's probably a red flag that there's delusion in the market, that we're misallocating funds collectively. So I'm personally of the understanding or belief that we should have a wide variety of risk profiles of people in society investing in all different types of things. However, there are common mistakes that people can make due to the consolidation of people who invest professionally who have an advantage. So it seems to me like one of the common mistakes is that people are investing in spaces where they're up against a much more intelligent investor, be it hedge funds or computer algorithms, etc., that make it difficult. And what I see you doing is helping people understand this. But I'd love to hear in your words, how is that wrong, or what more accurately are you doing in the world?
I don't think you did a good job at portraying that, because really, I think people can only take actions and make decisions based on their experience, and everything they hear or see is going to be filtered through that experience. And we're growing up kind of being told that Wall Street, smart money, they're the professionals. If you ever take a look, I once did a search on Yahoo Finance and found out, this was a few years back, but there was over 25,000 professionally managed funds. That's the smart money. I thought, so I wonder, how many of them, what percentage of them make at least 10% or more a year? You want to be able to at least outpace inflation, right? Well, I was shocked to find that less than 5% of over 25,000 professionally managed funds were able to actually earn 10% or more per year. Isn't that crazy? And you think about, well, aren't they the ones making all the money? People don't realize that most of the professionals in Wall Street are making money through fees that they collect, whether they win, lose, or draw on your account, right? And then most of the funds will actually hold on to a downturn in the market with the perspective that the market will always move higher at some point. So just hang in there, double down. This is a time to be adding money, not coming out of the market. And that works when you've got a bull market like we've had for the last 10 plus years, right? But what if the market turns? What happens when we enter into a bearish market and we can no longer sustain those? Or people who are coming to a place where they're planning on retiring or exiting, and then all of a sudden they've just taken a 30 or 40 or 50% hit. Well, that took years to make up, and all of a sudden it's gone in a couple of weeks, right? So I think, delegating those kinds of things out is the easy thing to do, and it's the logical thing to do. People don't realize that with a little part-time effort, little ambition to be a little more skilled and know how to manage my own money, no one's ever going to care more about your money than you do, right? And so one of the things that I learned the hard way was when I was focused on a goal, I kind of believed, hey, whatever I put my mind to, I'm going to succeed, and that's great. But what happens is we get this tunnel vision, right? It's kind of like I want to pass through the intersection just as it's about to turn red. And what happens is my field of vision just goes from this to this, because now I'm just focused on getting to the intersection. And I'm probably looking, I'm just looking at little things that are logical to me, but I may not notice necessarily that maybe a car on the other side is coming and isn't slowing down. And if I was paying attention, I realized that guy's going to run the red light, will T-bone me if I don't slow down and stop, right? Or there's a police officer on the other side. So in other words, we make decisions irrationally when we feel pressured to do something or to get somewhere, to accomplish something. Well, you talked about the kind of the crowd, the consensus, the delusion. So one day I almost punched my monitor because I was so upset. And I was trying to kind of figure out how to be consistent with my analysis in the market so I could invest with consistency. That was for me, without consistency, we have nothing. Because I spent 14 years starting over and over and over. I'd invest in my education and training with something. I'd go into something and it would work for a little bit, make some money, and all of a sudden, inevitably, it would start to work inconsistently or poorly or not at all. And I'm like, oh, what happened here? Something's changed. Okay, now I'm back to the drawing board. What's working next? What's working now? Or is there a version 2.0? That was exhausting, and that cost me not only 14 years of my life, but over $300,000 over that time just on education with nothing to show for it. That doesn't even include the lessons I learned from losses that I took on top of that. So I thought, well, I need to figure out a way to be consistent. So I thought I found something, and that one day I almost punched my monitor. I thought, okay, I got to go calm down. So I got in the car and I drove to the beach. And there's a place called Silver Strand Beach in Ventura County, California, Southern California. And it's a little popular surfing point. But it's not a very busy beach either. So, but it's nice because they've got this concrete bench you could sit at and hang out and listen to the ocean, watch the waves. And so I noticed that day there were 17 surfers, and I was looking at them. I think because I was just upset, so I started just to kind of distract my mind because I was boiling over. I started counting them. I counted 17 surfers. But what was interesting is there was 2 surfers off to the left and 15 kind of huddled closer together, and those 15 kept taking wave after wave. They took numerous waves. They were very active, crashing and burning quite a bit, getting some nice rides every now and then. And I thought, well, those 2 on the side probably are like amateurs watching the regulars, trying to learn from them some techniques to be able to have some good surf. Well, after about an hour and a half, a pattern emerged, and I realized, wait a second. Every time those 2 surfers would take a wave, they would have a pretty sweet ride. They didn't crash and burn. And in fact, they hardly took any of the waves that came at them. They were very selective. They had figured out some way to filter out what waves were not likely to give them a bad ride. And I was like, I had this epiphany. This was a pivot point in my life. And I thought, I'm logically going to the market and looking for opportunities to make money. And that's why I kept getting blindsided by things I didn't know were there. And I never understood what it was, and I could never explain. It's just like the market changed. Go look at the next new thing. But I thought, well, what if I did what these guys were doing? What if I looked for opportunities that were not likely to lose money? Everything changes with that perspective. And people don't really realize that little minute shift in thinking and perspective, what a dramatic and profound impact that has. Instead of looking for opportunities to make money, we're looking for opportunities not to lose money. Well, that got me to start to look at all the different factors that affect price going up and down. So when someone achieves a level of success, it's natural and very logical for them to kind of look at the stock market, the futures market, the commodities market, even crypto currencies and regular currencies, to basically try to invest their money, try to find ways to grow that or cash flow that. Because a lot of times people will work hard at something. They don't want to deal with the stress of dealing with people, negotiating, dealing with sales and whatnot, competition. They want to have a sense of control where they don't have to depend on anyone or anything else. Just their computer, reliable laptop, and internet connection, and they want to be able to be off and running to kind of continue their success. Well, so the financial markets are kind of a default place for people to go to. Well, unfortunately, most people, including professionals, only focus on fundamental analysis and or technical analysis, or the combination of both. They might look at some news or some other, but essentially they're looking at 2 factors. But actually, there's 8 major factors that impact the demand in the market that causes prices to rise and fall. And when you look at all of them together and their combined impact, suddenly you can actually decide, you're assessing with an 80% or higher level of accuracy is what we've proven over the last 10 plus years. You'll know exactly where the demand is in the market in real time, and you can tell when price is away from where the demand is. And if you think about this, this is a profound shift for many people. People don't realize that price in any market, even if it's real estate, it doesn't matter. It's a lagging indicator. People think price is the most current thing. It is, but it's lagging behind the demand. It's always following where the demand is. So as demand fluctuates up and down, if it expands or contracts, price is chasing and following that, and it'll overshoot and come back and correct. So you're seeing this dance between demand and price. Well, if you can accurately forecast where demand is in real time, you can see when there's an imbalance between price and demand. And once you recognize there's an imbalance, you don't want just any imbalance. You want an imbalance where you've got a significant imbalance, where you know there's not much room for price to move further away from where demand is. It's got to snap back. It's got to rush back to catch up. Those moments create what I call demand imbalance arbitrage. You're arbitraging, you're taking advantage of the difference when there's a significant difference between demand and price, because you have a very low risk for price to move away further from demand and a very high probability for it to catch back up and give you a profit opportunity in that cycle. And those cycles, because they occur throughout the day, each and every day, week by week, every week, that means they're very frequent in number. You no longer have to sit and wait these long-term moves or cycles on the market in order to have something that's confident, that's going to give you a consistent experience. In fact, I'm very counterintuitive about my approach, and it's because I learned the hard way that the more accurate I want to be, and the more consistent I want to be, and the more control I want to have, all leading to confidence, right? We want to be confident when we make a decision. And I'm going to be at least right 80% or better of my analysis every time I want to invest in something. Well, you need to look at the shorter time frames because you have more information available to you that you can act on, versus the further away in time you go, you start to have less information. You have more variables that can come in and surprise you. And so actually what Warren Buffett did to build his success, that environment no longer exists today. We don't have that kind of environment. And so buying and holding is a real volatile mess. And I get a lot of people who come to me, they're down 30, 50% before they figure out that someone like me exists, can help them mitigate that. Well, that thing right there is a perspective shift alone, because you're realizing, just like weather, when you have a storm coming that you're predicting that's in a week away, it's likely to dissipate in a few days. You don't have the same accuracy as you have when you have a storm that you're predicting in the next 24 hours. Does that make sense?
Yeah. Bring it down to earth for me. So I understand conceptually where you're coming from, which is there's opportunity to effectively offer value to the market, which is another way to say make money, and extract value from the market, make money by noticing where the demand is and closing the gap between the demand and the price of something. What specifically comes to mind for you when you think about turning that into practice?
So most people would know that there's a price chart that shows, where price is for any symbol, for any market, for any asset class. Doesn't matter what they're interested in. If you can put it on a price chart, it's great. When you look and see, now I have a proprietary analysis that I developed, and what it does is it takes all of the major forces of supply and demand, and it takes into account their impact on price, and then it kind of paints a very smooth line, kind of like if you'd sit in your car and you look at your fuel gauge. That's kind of the main thing you look at to know where, how far you're going to be able to go. If you and I wanted to go on a 250-mile road trip and you had a quarter tank of gas, you and I knew there's an instant visually obvious indication that you have to stop and refuel. A quarter tank of gas won't get you 250 miles down the road. So what it does, it combines all of those and tells you kind of like what's going to power price, what's going to fuel price, and is it going to fuel it up or down? And that's that real-time demand analysis that we were talking about. Well, in practice, when I apply my analysis and as I teach, you start to see, oh, demand is actually up here and price is down here. There's a significant gap between where price is and where demand actually is. Well, you said it perfectly. I can offer value. What's my value? It's my liquidity. What's my liquidity? It's my money. When I put my money in, I'm causing the market to become more liquid at that moment in time in that cycle. I'm providing liquidity, and the market requires liquidity, right? The more liquidity there is in the market, the better the market moves. It's more orderly. Everyone wins, right? So we can't hurt each other by investing together, right? Now, we can in the sense if we're all doing the same exact thing. But if we're taught how to do it individually, how to kind of go fishing for ourselves and capture our own fish versus trying to be fed fish, that's the key here. Because you don't want someone who says, here, guys, here's a buying opportunity. Well, when everyone's going to go for that buying opportunity, guess what an investment bank like the Goldman Sachs is going to do? They've got guys that look at that, oh, here we go, and they can target that, and they can actually trade against that because they can see the order flow, and they can. There's a lot of strategies to go work against the market participants. So I'm very much against, everyone having some specific buy signal and sell signal, because it doesn't. And anybody who's had any years of experience doing that will tell you they struggle with consistency there.
And where are you getting this? Like, what would be an example of a most recent trade that you made where you've identified? It seems to me identifying the change in the demand is the key here, because you know what the price currently is, and so if the demand just changed either in a millisecond or in a day or an hour or a couple of weeks, whatever it is, then placing a bet on that, like both identifying the price and placing a bet, seem to be fairly simple. At least if you're using crypto, you can use an exchange like Kraken or Coinbase. If you're using equities, you can use a brokerage like Fidelity or any of the others. So how do you, So I view those parts of it are pretty straightforward. Where are you, do you consider yourself unique in your vantage point of the speed of identifying the demand change, or the perspective in which you view demand changes, or some specific area of the world that you're focused on?
Well, all of the above. And so what we're doing is what I had figured out was a way to, on the charts, I was able to pull up different indications of the different aspects of supply and demand that are being affected. That, now with internet, thanks to the data that's available, you can basically gather any kind of data that you want, right? You can procure that. So what I did was I was putting those up, and I started to kind of realize, wow, I can correlate this with that. And I started to slowly, over the a year and a half, literally 10,000 plus hours. I was putting like 16, 18 hours a day, sometimes 20 hours a day, 6-7 days a week during that year and a half to figure this out. I was obsessed with it, but I figured out how to actually pull that data in so I could put it on a price chart and see what the combined impact of that supply, all those supply and demand factors are doing. And so I can start to see that, oh, wow. So for instance, if let's say again, so, price is up here, you've got this price chart. And so you can see this like fuel gauge, and you can see that price is moving up and the demand is falling off like a rock. I'm going to tell you something interesting. Here's a little insight. No market can crash or even significantly correct unless the demand factors first shift dramatically. And that's something you can identify. Just like you and I, if we were walking outside a clear blue sky, it wouldn't start raining on us. We'd see the clouds up in the horizon rolling in, getting darker. That's something you can identify. And that's also something that takes time to build. So that gives us plenty of time to take defensive action, right? Or take advantage of it if we want to do something in the rain, right? But so what happens is when people realize, my God, I have a level of control over my long-term portfolio, as well as I can do something short-term in an efficient way where I can accelerate my earning potential by learning the skill of doing real-time demand analysis, and then seeing where there's significant imbalances and taking advantage of those. So it wouldn't be a bet, it would be actually investing in that cycle, because you've got so much information available to you that you really are investing in a very efficient, very effective way in a cycle for the price to catch back up to demand. And so what happens is you have a control where you know that you're going to be right 80 to 90% of the time on your decisions. But the problem is, and here's the problem, just because you can see where demand is all the time doesn't mean that you have an opportunity to take advantage of it, because Just like you and I can forecast a storm, doesn't mean that we should be in the middle of the storm running our errands, right? We should wait for the storm to pass. So the market is often more stormy and not congruent for us to engage 70, 80 to 90% of the time. So if you put like, say, a couple of hours a day, whether in the morning or in the evening, it doesn't matter, but you just devoted 10 hours a week, okay, Monday through Friday, 2 hours a day, you might actually only be active for half an hour or an hour of that time, but you're going to be right 80 to 90% of the time. So it's not something where people come in to get rich quick. It's something to come in to get to be steady, to be consistent, to have control, and to outpace inflation.
Let me ask you this. I'm still mostly connecting with what you're saying. Are you when you're using the weather analogy? Is your method for identifying demand maybe like skimming Twitter, like talking to people on the street to identify how they're feeling about something? When I'm thinking of demand, I'm thinking of it kind of loosely in terms of psychologically what people are interested in. Like, could you have identified the demand in toilet paper by being in the grocery store day one and seeing everyone buy it in the pandemic, and then you go and short sell toilet paper? Yeah, is this the kind of thing you're talking about, or are you more talking about like BIPs and trading, where I'm looking at the lines and analyzing algorithmically how prices of different commodities are moving? Yeah, go for it.
That's a great question. So no, it's not skimming Twitter and things like that. No, actually, everything that you need, all the data that you would need, would be on the price chart.
Okay.
And what I did was I took the data and had it so that it was being pulled through onto the price chart. So I didn't have to look at news anymore. I didn't have to look at the TV, watch CNBC or any of that stuff anymore. I didn't have to, all I had to do was make sure to find out, is there scheduled news when I'm interested? Because I don't want to trade around a time where I know the market can become very erratic suddenly, right? Because that's a time where it's obviously not going to be orderly. So if there's a market open or a market that's about to close, I don't want to be involved within about 20 minutes, half an hour around that. If there's a scheduled news event, I know the market's going to have some weird reactions, so it can get erratic, so I don't want to be around that. But outside of that, I don't look at anything else. Everything pulls in on the chart, and it's looking at the fundamental analysis. It's looking at all the technical stuff that people are used to using, but then it's also looking at volatility. It's looking at volume, order flow, trade flow. It's looking at imbalances in supply and demand. It's looking at prime liquidity pools. A prime liquidity pool are areas in the market where a market maker or a broker or Goldman Sachs investment bank sees, because of the data they have from their own clients, which, by the way, most people don't realize that the broker in the risk disclosure statement will tell them, we're going to often be taking the opposite position from you. They're going to be trading against the client. Okay. So they use that data and they trade against them. Well, you have to think about that. It's like, well, if that's the case, shouldn't I take that into account and be on the other side of that? Don't not be the victim. If we know the market's manipulated and rigged, shouldn't we take that into account? So we want to know, well, where is that area in the market? At what point can it be manipulated? Where can a broker or a Goldman Sachs come in and trade against me? Well, that's a prime liquidity pool. And so it's kind of an area in the market that says, this looks like an area where price, every time it comes to it, it bounces. But it's also inside a prime liquidity pool where there's room for it to actually kind of spike a little bit out of that. And most people don't realize that. So they think, oh, well, if I go in, I'll just go ahead and put an order that if I'm wrong, it'll just get me out and I'll take a little bit of a loss or whatever that loss is going to be. But actually, they should be thinking about this area down here, not up here. And so that's that prime liquidity pool. So again, that's extra information. It's all pulled into the price chart, so you can see it visually.
Got it.
So that's what I developed was the analysis that can be done on the chart without looking at anything else. You don't have to do anything outside of just look at what's right on your laptop screen.
Got it. And I've heard
does that answer the question?
It totally does. Yeah. So you're not taking into account like subjective. People will. For instance, there's a friend of mine who was telling me, I short sold the market as soon as I saw the virality of COVID in China spread throughout Asia. Like, he was very in tune with the scientific patterns of disease spreading. And he's like, this is high likelihood this is going to spread to every country. And there's even a chance it could cause like a huge deal. And he turned out to be right. But that's not what you're talking about. You're talking about close the windows, put me in front of a computer and analyze numbers that are representative maybe on a graph And then are you thinking specifically about developing algorithms? I've heard you say the story of the nose running. So like the refrigerator runs, the nose runs, I run, and therefore humans have some ability over computers to assess situations. I interpret that, tell me where this is wrong, but I interpret that as true if we also have, if I'm also consuming news, if I'm also learning, and I can figure out what the zeitgeist is, that the computer just doesn't have access to that level of society complexity yet. But is that, do you think of it as like where you spend your time specifically is on building algorithms that analyze this data?
So actually, I don't use an algorithm. I can't. So for this reason, let's say you and I gave a bag of just Legos to 10 children, right? And they each got the bag, and we told them build a house. All right. You know that each of them is going to kind of build a house according to their imagination, and some of them are going to look really cool, really good. Some of them are going to go, that's not really a house, but it kind of looks like a house. I get it. You know, you and I can interpret the context, whereas a computer needs a very rigid, very defined explanation of what something is. And even if it can go into that machine learning and the AI where it's kind of learning, in the market specifically, it's always changing and evolving in ways that are never like it was in the past. So it's really impossible for a computer to ever get to a place where it can interpret the context of something. Whereas you and I, once you have the building blocks of a skill set, that here's the analysis, here are the building blocks of the analysis. Now you go apply that and you go, oh wow, it can look crazy, weird, it can look sloppy, it can look like it's lazy, and yet you'll be able to interpret this means it's a buying signal. So the market's going to be bouncing. There's a right over here. There's price can no longer move any more down. Demand is up here. It's going to have to come back up. We can interpret that where a computer might see that and go, ooh, things are getting even worse here. I better sell short. And actually, it starts to feed on itself, and the market goes up instead of going down. And you remind me of a story. I had a gentleman once who was a professional trader. He sent, I think it was an email. He sent out. He says, "Do you remember when the tsunami hit Japan? And you remember that big thing? Okay, well, that was a negative event, right? That's a bad event for the economy, right? So he said, I feel sorry, and I'm praying for the Japanese people, but this is also a great opportunity, so I'm shorting the Japanese yen." Okay. Now, it's logical to short the Japanese yen because it's a disaster, right? That should be bad for the currency. Actually, what happened was the Japanese currency shot up and became stronger, not weaker. Okay. Why? Because Japanese are very loyal to their country. And so a lot of the money that was overseas was pulled into the country to rebuild the country. They're very proud. There's a high level of honor and pride. And that strengthened the currency very, very quickly. So he took a pretty big hit there. So sometimes our logic deceives us, right? So coronavirus, and this is where we get ourselves into trouble. We make these decisions and we have success.
Yeah.
And then we think we've got something, right? It seems logical to us. What we don't realize is we might have gotten just fortunate. We were lucky, right? Because what if something had come in to just all of a sudden impede that?
Yeah.
It could have been a boon, right? Not a crash, right? So you never know how things. That's that black swan, or those things that are kind of unexpected. I know what I know. I know what I don't know, but I don't know what I don't know.
Right.
So that's why I say if we can make a little bit of a paradigm shift for someone who wants to have a level of control, confidence, and having consistency, right? You need to have clarity. Those are the 4 C's I talk about: clarity, consistency, confidence, right? I said clarity, confidence, consistency, and I just spaced out. I can't even.
Clarity. It'll come back to you.
But we'll come back to it. Control.
Okay.
So the control piece is important. Why? Because when I don't feel I have control, I feel pressured. When I feel pressured, I begin to behave differently. I think about, you're an adult, you drive a car, right? You've been driving
Hmm.
a car for years, right? You know how to drive a car. You notice how when you're under pressure, you're running late to an important appointment, you drive your car a bit more aggressively. You rationalize behaviors that aren't self-serving, although they feel like they are because you think you want to get on time or save some time, right? But that can cause you to be even more late or even have a life-altering event. So we begin to do self-sabotaging things when we're under pressure. So we want to always remove pressure and always come when we have money and we want to know how to grow it or cash flow it or build it in whatever way we want. We want to have a level of control over that, not where we're speculating and gambling over the outcomes. So like we don't take bets. We actually take investment positions, even though they're on the shorter time frame, may seem like we're intraday or day trading. We're actually not because we're not speculating. We're actually investing in these very short, very effective cycles where we know there's a significant imbalance. Think of a rubber band that's overstretched. It's got to snap back, right? That's what we're looking for. And that's what the analysis does. It identifies those moments when you have such a significant imbalance. It's so clear and obvious. It creates a very effective, very profitable investment opportunity that has a very low risk to it. Does
Yeah.
that make sense?
Yeah, that makes sense. Although I think of the difference between a bet and an investment as not the degree of risk associated with either, but this is me. This is how I think of it.
Yeah.
Is the degree of entertainment associated with it. So I go to the casino
Yeah.
and I place bets, and I'm not doing it to make money, although it's super exciting when I do. It's the
Yeah.
entertainment value. Whereas when I'm making an investment, I'm not entertained by this. Like when I invest in
Yeah.
some real estate thing, you're doing it strictly for the purpose of returning on that and returning money on that, having it grow. And so I mean
Correct.
maybe that's how you think of it. But I when I hear we're not placing bets, we're making investments. That's where I think of the
Yes.
difference. When you earlier when you're describing your friend's short selling of the Japanese yen, it made me think of it made me think what's most important. What is the if you could have one focus as an investor, uh, I think I think your focus would be how can I most understand the system? In other words, what is my greatest level of abstraction that I feel very confident in? How can I make sense of this situation? And the data on the screen tells you nothing other than the data on the screen. For instance, if you were told to invest in something, but you weren't given what it was like whether it was Apple stock or corn, you weren't told that. You're just looking at lines. You're no better than a computer. You can't be because you're just data crunching. But then you add the context of what is Apple, what is corn, where are we in the economy, what is the United States' value proposition in the world and the currency, and you're adding in complexity. And I feel like the best performing investors will have the most accurate understanding of the model of the world. And this is where I recently dove deep into Ray Dalio and absorbed his method of understanding the world, both in his hedge fund and how they make decisions, but also his theory of the evolution, growth, and destruction of empires, which I found super interesting. And to me, it was there's not many people who synthesize global events in a way that has a story that makes sense from a almost evolutionary and biological sense. It's like everything that's alive came into being, everything that's alive will die. That process grows. We're grouped into larger beings called species, and even those evolve. And then we're part of civilizations, both cities, states, countries, and those have identities that come into being. They either flourish and then they dissipate. And this like pattern of coming and going along this arc seems to be something that you can root down, because it's all about like, where can I root down into my belief so then I can trace it all the way back to a investment decision. Because if you're not rooted down to something, and I think when I say rooted down, I mean things like evolutionary theory, right? The idea of biological psychology, where it's like I'm putting males and females generally have the feminine and masculine has a different way of demonstrating. Men will buy the fancy car to attract the pretty woman. And so there's a pattern there that is rooted in biology deeply. And I think This way of thinking for me has made a lot of sense. Whereas if it's strictly rooted in the ones and zeros, analyzing of equities and crypto and everything, it loses the context. It has the content to the most accurate, fastest possible degree, but the context is like, what does it mean in the bigger picture, and how accurate is my bigger picture? I'm curious if any of that made sense.
That makes total sense. Actually, I actually had a similar problem. I was overwhelmed by the crunching of the data and trying to keep up with all these things. So I had to be subscribed to the Investors Business Daily, Wall Street Journal, Barron's, Financial Times. Oh my gosh, CNBC, Bloomberg, and I was juggling. And it felt cool. I felt important. It was just really, a great time, but it was also a lot of work and it was stressful.
And doesn't that feel like noise? I mean, doesn't it feel just like, how do you make sense of Ukraine launched a missile at Russia and Argentina's inflation is skyrocketing. And it's like, okay, have all these stories. What's the sense? What's the story?
So when it comes to keeping guard on my capital, so that I'm not giving it away. I'm not making money and losing it, but I'm making money and holding on to the majority of it, right? And any little losses are truly little. Like we're talking less than 2% or less of my entire investment account, right? So that way, no one experience is ever devastating or traumatic to me, both psychologically and financially. I think the psychological sting is worse than the financial oftentimes for most people. So I think it's important. That's why I think having a win rate of being right 80 or 90% of the time is important to sustain a process that you've proven is successful. Because if it's less than that, I start to kind of rationalize different behaviors to kind of avoid getting stung again, right? But when you're barely getting stung, and when the sting comes, it's really not much of a sting, then you can in perpetuity, you're kind of building on your success and growing it. So what I did was, if you can imagine all the complex aspects that go into driving a car, right? If I walk you through, all the steps you go through, you think, oh my gosh, I never thought that, yeah, there's so many steps to actually driving a car, but it's really very streamlined. You get in, and then the first thing we look at is how much fuel do I have, right? So that fuel gauge really is telling you most of what you need to know on what you can do with the car at that moment, right? How far are you going to go? And maybe you look at the oil gauge, right? And you see the oil gauge. Well, with what I've developed, in order to make it make sense, I streamline it into a very simple, visually intuitive indication that tells me here's where the demand is at all times in real time, right? So that I don't have to worry about all these other things because they're all kind of already being taken into account right in front of me, right? And then so what it does is it think of if you can. So you're not looking at ones and zeros. You're actually looking at almost like a graph of red and green. Green is moving up. That means there's a lot of buying interest. Red means there's a lot of selling interest, right? But this thing that kind of it kind of goes up and down like this. What that's doing is it's showing you, is demand increasing or is it decreasing? And then when you see price above it moving higher as demand is moving higher, that makes sense. We've got higher demand, we've got higher prices. But when demand starts to kind of pull back a little bit and price keeps going higher, well, you know that you're coming near a moment where the market needs to pull back a little bit. And then it pulls back, and then all of a sudden demand pulls back up, and then price starts to pull back up. Well, what happens when price makes a higher high, demand goes up, and then price levels out, demand goes up, price makes a higher high, and then when it pulls back, and then demand doesn't pull back, it collapses. Now, when demand collapses and price just pull back a little bit, you have to keep in mind demand always moves first, price catches up and follows after. So that gives you now a moment of time where you go, oh my gosh. For example, the coronavirus crash. I had a client, he was looking at when it made a higher high, and then when it pulled back, he saw demand had collapsed. And he realized, wow, this is going to be a double-digit correction. So he called his money manager, whoever handles his 401k, his retirement fund, and he says, please move all my money into cash. I don't want to be in the markets. So he went into cash, and then he took a short on his brokerage account and made 35% in 2 days on his brokerage account, but he saved his long-term retirement money from having to endure a 30% correction. And then when it bottomed out and started to recover, he got back in and rode the gains rather than trying to fill a financial hole he created for himself if he had just missed that, right? Does that make sense?
Mm-hmm.
And
Mm-hmm.
and so it's very simple, actually. It's not anything that's complicated. It's very simple, actually. It's kind of like, again, just sitting in your car seeing your fuel gauge. It's not much more complicated than that, if that makes sense.
Yeah. So you're basically saying, like, as I interpret it, that people who are doing this, people who are trading, spending hours a day trading BIPs and analyzing price and demand, the value that they're adding to the market is kind of a insulation force, so to speak. Because most people will just put their money into the S&P 500 or somewhere and just let it ride. They're not making, most people are not spending day-to-day trading decisions. And the closer, the more efficient the market is, through more liquidity in the market, the more intelligent buying and selling decisions that are made kind of help move the market, make the market healthier, and which benefits everybody. Yes. And so you're specifically talking not about long-term investment decisions, about analyzing the market, understanding these like macro theories of the world, but more specifically analyzing the ups and downs of the graphs. My question is, given that case, why is what we're doing, why is your friend who saw the graph go down, why was his human brain uniquely capable of making that decision where a computer couldn't or doesn't currently fill that gap? And is this kind of a temporary space we're in 2022 where computers are not yet, they don't have enough liquidity behind them, or they're not sophisticated enough, assuming just constant progression of computational sophistication for decades to come?
Yeah. So that was more of a simple, kind of an oversimplified example of the analysis that I would encourage anyone to learn how to do for where you can do your own analysis and know what decisions you can make with confidence versus just giving that out to someone else who just wants to collect a fee just to do something for you, right? But the context is the piece that people miss very easily, because they think, well, anything I can do, a computer can do better. To a point, yes and no. You have to define what the computer is going to do. Those definitions, like, again, we go back to you mentioned that analogy of runs. The word runs, R-U-N-S. Okay, my nose runs, my car runs, the water runs, right? That word means entirely different things in each of those instances. Those instances are very different from one another. And so if a computer were to use the word run, it sees runs, it thinks something's running. It doesn't mean that it's actually going to, right? So my nose runs, the computer might think that it's going to leap off my face and run, right? And that's where you see big investment funds, they've blown up, or they'll have a losing quarter because the computer didn't interpret the context of the market. And so when I was giving that example of that guy who forecasted the Corona crash, what happened was he was looking at the context because it wasn't an ordinary pullback. It's because there are some things that you'll see, for instance, that will occur. Let me step back. When you buy a diamond, would you ever buy a diamond looking at only one side of the diamond, or would you look at all the sides of the diamond?
All sides.
All the sides, right? Because you could have a flaw on the opposite side of where you're looking, right? And you wouldn't know unless you looked at each facet of the diamond. So think of this as where the computer is going to struggle is this. We have to look at different facets of the market. And so when the computer is looking at different facets of the market, it might see something that looks like it's going to collapse. But there's also a context. One of the building blocks is, remember I talked about how demand collapsed first and then price was going to follow after. So that's an oversimplification. In that example, the point I was making is that everything else was kind of also agreeing, right? There's a consensus there in the analysis, right? All the different facets are all kind of pointing that direction. But what if you get one facet that looks like it's collapsed, but then the other facets are not supporting that? What that means is the exact opposite of a crash. It means that now you just identified the peak low of any movement pulling back, it's now about to take off in a nice significant way back to the upside again. So that can sound contradictory and confusing, but that's part of kind of learning how to understand the different facets and how they all fit together, right? So that they all, there's a kind of this thing, all this gearing effect that kind of, they all kind of come together. So it's not just this one narrow focus, but it's understanding the market holistically, having a 360-degree view of the market so that you're not being blindsided by forces, right, that you didn't realize were there, that give you a bad experience. We want to avoid bad experiences. And that's how you do that, is having that analysis accuracy and the control over what you're doing, your decision-making process.
I like that. Do you know if I've heard a financial planner, a friend of mine, describe financial planners as glorified financial therapists. And I think there's a lot of truth to that, in the feeling that people have when they're distressed or really excited about the market, and they call up the expert and they say, we got to call the financial expert. You have to have a license to even give financial advice. And so it's kind of this worshiped stance in our society that often serves at least a majority of the value in the comforting effect that these people provide, and the sophistication and improvement of their investment decisions over what you would make, or what you would make in the general market if you just put it in the market, often is like one of the first things you said, right? You analyze 20,000 investment brokers or investment advisors, and only 5% returned better than 10%. So they're not killing it. They're not doing an awesome job. And I wonder if the world, are we moving to a place where there's a convergence? The market is drying up of individual financial advisors, people who want to sit around, talk to people about their accounts. Oh, I think you should move money over here, maybe move some over there. And is it being replaced by machines, automation 10, 20 years from now? Is it just going to be, I can program an algorithm and that just trades for me? Like, how is trading trending? How is it like looking in 10 years from now compared to how it looks today, from your perspective?
That's such a Licky. I'm so glad that you asked that question, because most people don't think about that. So the logic would have you saying computers are taking over, AI is taking over. What we're finding is that even the big banks who were excited about AI, when they depended 100% on AI, they had losing quarters.
Yeah,
they had a lot of banks had losing quarters, and funds blew up. And they're realizing you need to have that human impact, human touch. So I think those people who are attracted to or run after those things will learn from experience that was not the wisest decision. And they're going to find out that if they want to do something, do it well, and get the kind of outcomes that they want, they're going to have their hand on it. They're going to have to take some initiative, honestly. And I think as the world continues more down the AI and automation, in the financial markets, I think the only thing they're going to be able to sell you on is that eventually the market's going to go up, because of inflation, right? But that might be comforting on the surface, but if you look at it in practice, it might not match up with the timing of when you need your money. And so maybe when you need your money, you realize you're in a downturn and you're like, I'm going to have to go get a second job at 70, So it's one of those things. It's a catch-22. It's both a blessing and a curse, isn't it? So I think I have a friend who's a top tech IT guy, and he deals with a lot of internet security, and is, I think, one of only 6 people in the entire world that does what he does or specializes in what he does. And he says we're not that old, but we're not that young, but I'm in my 40s, and he says we're not going to see in our lifetime a computer, even quantum computers, will not be able to interpret context the way the human brain can. And so for what we're doing for investment purposes, it's going to be difficult for someone to invest in something and expect a sustainable level of consistency outside of what they're going to be able to do themselves.
Gotcha. So people are adding your banking story analogy is true today, But I would think immediately, okay, where's like hundreds of millions or billions of dollars are flowing into funding the smartest people on the planet to build software systems to compete with my limited brain and what I think corn's going to do and my context that I have. And I just don't have enough confidence in my brain to compete with that. Certainly, if we've seen that story play out in anywhere, it's in social media. And there's a lot of political agitation about the power that Facebook, Instagram, TikTok have behind the hood to like analyze the psychology of billions of data points and give you the exact ad, the person you want to see, the whatever it is. And people feel like they're falling victim, that they're losing to this experience. And it's a complex topic, but it does at least illuminate the power of AI to disentangle the context. And instead of looking at it like, what is corn going to do or what is COVID going to do? It's just looking at the data from that, the quantitative measurable pieces from that. And I think even in your story with the runs, and nose runs, I run, refrigerator runs, mistake made, bam, mistake learned, never happen again. It's like, that's the iterative power of computation that to me, here's my thesis. Tell me if you agree with this, is that as AI becomes more and more sophisticated, the space in which humans can compete on quantitative trading becomes compressed. But likewise, as money flows into that space to fund AI to make intelligent trading decisions in the hyper measured quantitative space, the qualitative space becomes undervalued. And there's great investment opportunities in that. Like, buddy of mine wants to buy a tractor, can't afford a tractor. He's got a great plot of land. He's going to crush it making a farm. I understand that. AI is never going to be able to understand all that. I give him $100,000 to buy his tractor and he kills it. That's just a story to highlight the areas where we could put money to generate return. And I tend to think those areas that computers can't touch are going to be the places of greatest return in the coming decades.
So if someone wants to have a hands-off approach, they have to be prepared for volatility and rude awakenings and outcomes that are surprising and never timely, right? They're never. So I think if someone cares about, and this is the thing, do I want to get to my destination or do I want to just cross this intersection? I think that's the real question we have to ask. When we focus on, I want to get through this intersection, we're not thinking about the long-term effect, right? And that's where most of us are blindsided and get hurt. If you think of all of our failures and, mistakes you've made, I bet you look back and go, I was so focused in the moment of just getting to, I was too short-term focused that I missed, really my target long-term. And now I've set myself back, right? Do you know, I've seen homemakers high school sweethearts are now in their 60s, never had they don't have an academic, degree or any work experience other than being, mom, raising kids, homeschooling them, and they're running circles around the professionals. Simple, and listen, I'm going to tell you something. You would think that what I did requires some, people tell me, you must be genius, you're brilliant. No, I'm not. I failed math twice, not once in high school. I barely graduated high school by the skin of my teeth by my economics teacher of all subjects. He wouldn't let me know if he's going to graduate me or make me repeat my last year of high school until the morning of graduation. I'm not that academically inclined. What I figured out was just pure grit. I just rolled up my sleeves and went at it. So sometimes we put, I think, a little bit too much value and we give too much credit to computers because the logic is, well, they're going to work faster, they're not emotional. All that's true. But there are some things that humans really are going to be able to do that computers will never really be able to do. And again, I think in this particular case, when it comes to investing and knowing how to have control over your financial future, the human mind is going to have that context. And so, but I agree with what you're saying. You are going to see the industry move in the direction you mentioned. The problem is you're going to also find a greater divide and with people who are actually seeing a real beneficial impact, and the ones who are really going to do well are going to be the ones who've taken control and taken the personal initiative to build a skill set where they are making the decisions and not giving it to a fund or a computer or a robo advisor. I think we're going to see that. And that's where, unfortunately, you're going to see that big divide of the rich keep getting richer, the poor keep getting poorer, right? You're wiping out the middle section of people who think they're going to still be okay by giving up their right to make decisions on their capital and on their financial future. And so I think you're going to see a lot more disappointments, a lot more devastation than we're going to see success, unfortunately. And that's just human nature. We're inherently lazy creatures, aren't we? We always want the easiest, fastest, shortest, but there are some things where you just have to kind of put your foot down and say, no, I'm not going to go there. I'm going to have to do this for myself. I don't want someone to feed me fish. I want to go learn how to fish, and I can feed myself for life.
Yeah. I think of it as when you understand what it means to have food, then learning to fish makes more sense. If you're just trying to eat tonight, then going to a restaurant, buying fish makes more sense. This is like, to me, it almost feels like there's these short-term, long-term trade-offs. You could describe it as, I may never learn to fish, and I may never need to learn to fish, and I could always just go to the grocery store and buy it. And this is in the tech world, especially a really common ideology is become hyper specialized. Your friend, there's only 6 of them in the world. Do what you do. Right. There's a great return on that. You're providing a lot of value to the economy. You're getting paid a lot for it. So the argument is clear. The downside is when you're super specialized, you're not resilient in the case when the system kind of cracks. It's like, okay, the world changed. We no longer need your friend's expertise anymore. Now, where do you go? And so I think having the balance of I'm really, really good at what I do, but I'm also capable of other things or adapting to other things, sets yourself up for success. And you want that not just for individually, for your own selfish perspective, but you want other people to inherit these ideas, because if people are collectively resilient, then we all benefit from like climate change, social structure changes, psychological challenges that happen across the board. It's like you want a society that's capable in their individual areas, but also resilient collectively. So I think knowing a couple of things really, really well and just generally being aware of most other things is, I think, pretty good general advice on how to spend your time, spend your expertise.
I agree. I think it's critical that people know, and I think the one thing I would say is everyone's insurance policy in life against failure is learning the skill set of knowing how to manage and invest my capital, so that, because if I'm going to rely on others, that's a hit or miss scenario. And I'll tell you this: how many horror stories have you heard? Even, in fact, a great statistic is if you just look at professional athletes. How many of them have made millions and then retire broke, poor, or working at a restaurant? Celebrities, not just professional sport. So a lot of people make a lot of money. I mean, even these tech people will make a lot of money, and then they may get lucky, but do you really want to get lucky? You should have a skill where you're deliberate, where you actually control that outcome. You have a very controlled outcome. If I do this, I'm going to get that. I'm going to be right 80% of the time. You understand? You want to have a level of control. That's that thing that people want to do is like, I don't want to put more time into this. I don't want to worry about anything else. I think it's one of those things where you really have to rethink and go, why don't I? Why what if I've worked this hard in my 30s and my 40s and I've made this money? Then what if I'll give you a great example. I have somebody that I know that came to me. They made a lot of money, and they gave it to a friend who they trust and is a good person. And that person lost 90% of the capital. Okay. Through something that he didn't do anything criminal. It was just one of those things. It was just seemed logical, made sense, and it was a bad decision. Well, that person's now, their life is turned upside down, and what future they thought they had has been taken away from them. And so we do that to ourselves, right? Because we don't want to bother ourselves with learning a skill set to help us understand how to have a little more control over our success and our future.
So is your outcome of that story that when people accumulate money, they should necessarily go into this kind of trading, or more or less give money to people who are doing this kind of trading?
I think the natural default position is to give it to somebody.
Mm-hmm.
I'm always an advocate of learn for yourself a skill set, right? Where you know how to do this, where you know how to manage and invest. Learn how to manage your own money. Learn how to invest capital. Learn, and don't focus on making money. Focus on how to not to lose it. Everything changes with that perspective. In fact, Warren Buffett has a quote, the difference between successful people and really successful people is that really successful people say no to almost everything. So that it's learning how to say no, but in a quantifiable, right way.
Yeah.
You're able to, you have a process of analysis. Like those surfers, right? They learned how to value which waves were not likely to give them a bad ride, and that's why every ride they took was a sweet surf.
And
right?
one thing I like, Warren Buffett has said, and I think this is good advice, that when you make money and you don't want to spend your time, regardless if you have money or not, if you're managing any money, then you either do that professionally or you just put it in the market. But like giving it to other people to manage their money tends to just be a losing scenario, and they rarely beat the market. Do you think most people, when they accumulate some wealth, should just put it in the market if they're not going to want to spend, hours a week doing this kind of trading?
Historically, the indexes have beat most funds, right? So most funds, they use the index to kind of measure how well they did, right? And they often are lagging behind what the index does. So yeah, putting it in an index fund is kind of an easy way to just do that if you really just are, I don't want to worry about it, and I don't want to think about it. But then you have to be willing to put up with the 30-50% downturns that occur along the way. If that happens at the wrong time, when you want to pull on that money and you realize, or what if the market shifts and no longer maintains the bull run? This is the most incredible bull run we've had historically ever. I mean, it's unusual. It's very bizarre. So, could that lead into also a dramatic depression, where we have a bear market that just keeps going down and down and down and down for years, and and it's going to feel like there's no end to. So there's a lot of gamble, right, on the future now. And I don't know if anyone's familiar with a book by Klaus Schwab, The Great Reset. That's a very eye-opening book. The guy lays out a plan in which he's somehow, through the World Economic Forum and all their, the people that are the members, are planning to re-engineer how the world works and get us to a point where you'll own nothing and be happy. I don't know how that's going to occur, but who's going to survive that? And so you have to think about, well, what people can navigate through a scenario that's increasingly hostile against entrepreneurship, right? Against businesses, against property ownership. Well, if you've got money, you have investment capital, and you know how to navigate the economic financial system with that, you're going to be the person on the top end, aren't you? You're not going to be at the bottom of the food chain. So you want to be at the apex of that, not at the bottom where you're being steamrolled and governed in such a way where you don't have control over the kind of lifestyle you want to have, because someone's going to say, we're regulating you out of this market, this industry. As an investor, your capital is what you get to vote with, right? Where I put my money, I get to vote, and I get to have control over where that goes. And these guys have built that level of power and control and wealth through the financial markets. So doesn't it make sense to actually know how to navigate through the financial markets, since that's their very heartbeat and what gives them their power? So I think that's a question we all should face and think seriously about.
Yeah.
People think, well, it's complicated. It's like, it really isn't. It's not. It's no more complicated than learning how to use a smartphone or a computer for the first time. If anyone has used a computer, then when you first got on it, it was intimidating, right? And it felt overwhelming. But then it was you realize, oh, it's point and click, and that minus sign means minimize, and that X means close. Yeah. It's pretty straightforward at that point, right? And it's a part-time effort to figure that out. So I think anyone who has anything that they want to hold on to and grow, I think they really need to take an interest in building their own personal growth through having that skill set of knowing how to invest wisely.
And real quick, I know this is kind of backwards, but were you doing financial planning previous to this, or what did you do?
I was a business consultant.
Business consultant.
I did business consulting for years. That's kind of what paid for all that 14-year period. And like anyone who makes money, I think there's always an interest to dabble in the financial markets, because you have, it's between you and the computer. You have control. You don't have to deal with people that you don't want to deal with and stuff like that. And so it was in figuring out how can I have control and have consistency. When I cracked that nut and gave myself that consistency, it also gave me all this abundance of free time, which all of a sudden, when people started asking me, how come you've got all this time to hang out, socialize, volunteer, when everyone else is working? And it's like, then people started asking, hey, would you be willing to teach me? And that's kind of how I got into the role that I got. But I never intended on being here. It was just, so that's why I'm a strong advocate for people to take control for themselves and have that self-confidence that I have the skill set to navigate through any economic environment and thrive, not just continually strive.
I dig it. And are you active online? Are you writing personally on Twitter or anywhere people could check out? I'm sure we'll include notes to Market Forecasting Academy in the show notes, but you personally, are you out there?
So I'm a little bit lazy that way. I haven't, but I'm working on writing a book. And because people always ask me, how come I don't know about you? You would have saved me years. You would have saved me so much money if I knew it. And it's just like, okay, I'm now as kind of the word gets out, I'm opening myself up to scenarios like this where people can interview me and share some time and just kind of help educate people and open people's minds to a whole different perspective on investing. And so I don't really write much. I'm not really a marketer. I really enjoy I do what I do. I enjoy it, and if there's opportunities to share and speak, I do those. But I haven't been kind of pressing hard on trying to advertise or market that. So unfortunately, no. But if you look me up, you'll see different interviews. I have a little mini course for people to learn and educate. I'm not out there selling anything to people that, I want to educate them. If they want to learn what I do and they want to understand, they have to understand what I do first, right? So they can go through the course. It's complimentary. It's on marketforecastingacademy.com. But that's, they'll educate themselves on everything they need to know. And if they want to work with me and they want to acquire the skill set, there's a short application, and then there's an interview and a real honest to goodness evaluation that occurs to see if it's a good fit and makes sense. Because I don't want anyone coming in with false pretenses. There needs to be the right situation. People have to also realize that you don't want to come to the markets with any pressure to need to make money, to do this to pay bills. You want this as an enhancement. You want to set yourself up for the future. It's something you should want, not need. You don't want the pressure. And unfortunately, I get people who say, I need this. I'll do whatever it takes. I'll pay you twice your fee. And I say, I'm sorry. I don't think you're understanding what my motivation is. This is not about money. This is about making sure you succeed. That's a big responsibility I take. I don't want to take someone on and help them self-destruct when they've got that personality to do that, right? They're married, they got kids. I don't want to be part of that. So I'm very careful for that reason to ensure that people are in the right space, the headspace, the circumstances. And that's kind of also something I think your listeners should think about is don't ever go into something needing to do it, because that pressure will surely lead you down a path of making a mistake. And it's painful to have to learn from that. So it's always best to kind of be sober, take a step back, and really think thoroughly about what is appropriate for you and what direction to go.
Any particular book, if you had to name one book that played an influential role in your development of the understanding of the world or your personality, or just shaped you in general?
You don't hear this very often, and I'm not here to preach, but I'll tell you the most insightful book that helped me to understand how to live my life and how to make things work was the Bible.
And did you just read it, or did you listen to somebody interpret it?
I had to not just read it. Reading it was confusing.
Yeah, it is.
And on the surface seemed a bit contradictory in many areas. And it was only through we go back to the word context, right? It was only through the proper context that I understood. So I had to really study and research. I made an effort to do that. And boy, when it took me, it was a lifelong process, honestly. But once I worked through that, things clicked. And when they clicked, all of a sudden, all the puzzle pieces of my life came together. And I because of it and through it, I've never been more at peace. I've never been happier. And I've never felt more balanced. It's amazing. I think people judge it by on the surface, and I get it. But there was something about it that I was like, I gotta crack this nut. I gotta figure this out.
Totally.
So I just kept drilling through. And oftentimes, you said therapy. 2/3 of the time that I spend when I mentor clients, it's very therapeutic. We talk about these things, and we kind of realize that really, in order for you to succeed in anything, there's an inner growth that has to occur too. There's an inner virtue that has to get exercised, that then starts to that inner success starts to breed outward success, and that's an interesting perspective most people miss.
Yeah. I'll say the Jordan Peterson, who is a clinical psychologist and professor at the University of Toronto, a very public speaker at this point.
Love him.
He has a series where he has multiple videos that are like 3 hours long on the Bible with tens of millions of views on YouTube, which I listen to. And I'm certainly not a religious person, but understanding the concepts are super insightful. It's like we distill down the dogma and interpret the gold that this text has to offer, and he does that in an awesome way. So something else to check out.
I have to tell you, people, all of us, it's natural for us to kind of go after things that we think will make us happy. And so when you go after what logically is in front of you, I'll tell you one thing: our logic can deceive us, and often does, because it's very limited in its perspective. And the Bible really unlocked that arena and helped me to gain a perspective on how to really achieve happiness. And it was so liberating. It was unbelievable. People think the Bible is full of these restrictions and limitations, and it's just going to choke you. And I can't do this, and I can't live like that. There's a context to all of that. It's really interesting. And once you understand contextually, it's actually not as restraining as most people think. It's actually extremely liberating. It's the exact opposite. But it seems to be something that really opens up when someone really deep dives and really is focused on really understanding it, versus just, I'm going to look at this with a kind of a cursory thing. I'm going to judge it, and okay, I'm going to, So no, you really got to deep dive into it.
Yeah, it's difficult to just read and get value from. It's like his interpretation, Jordan's, was just like, it's like, oh, that's what all this means. So appreciate you saying that. Yeah, I haven't had a guest say that, and I think it's a good answer. So Roger, congrats on all your progress, man, and wish you nothing but the best.
Thank you. Appreciate it. It was great being here. Thanks for having me.
Bye.